Dipan Mehta, good morning.
Good morning.
There's
Good
one of
morning.
there is one of those Hindi pictures. I remember this line, "Ye kya ho gaya?" Right? I mean, it is "Ye kya ho gaya?" Why have we turned so sharply?
So, Nikunj, what is happening, according to me, it's my theory, is that because valuations are so elevated, analysts are kind of pressurized to give very aggressive uh, forecasts quarterly, annually into 26, 27, 28 also. And when the company misses those forecasts or those expectations, we are seeing a sharp crack in the stock price. Now, if you didn't have a very high expectation or you did not know what the street was expecting for Dixon or Zomato on a standalone basis, to a complete outsider, these results would appear to be fantastic. But then you have built in such high expectations because of high valuations that which are bound to get disappointed because end of the day, these are physical businesses. These are not businesses run on Excel spreadsheets. So when disappointments come, slight setback in a quarter or two, and this is what reaction is taking place. So that's my reason why even on, I would say, decent results, we are seeing such exaggerated falls in stock prices.
You've done some numbers, and I just wanted to take your perspective on that, which is let's look at the Nifty FY26 consensus numbers, which is about 1200 to 1230, 1240. Divide that with the current number, Dipan, just breaking it for our viewers. You come at a P multiple of about 20-21 times. Now that is where historically markets have traded, in and around 20 times, and you go below 20, markets they become cheap. So are we reaching that point where another 2-3% fall here, another 5% fall here, closer to 21,000, closer to 22,000, closer to 20,000, 21,500, this market generally becomes attractive?
Nikunj, don't just look at the P multiple in isolation and a historical perspective. We have a massive slowdown in the economy. It's reflected in the GDP numbers. It's reflected in a lot of the other data points. It's reflected very clearly in the earnings. I mean, you look go industry after industry after industry, with the exception of maybe pharma, you are seeing the lowest ever growth rates I have seen in the last several years or so. And end of the day, markets are slaves of earnings. So don't go by these, I would say global PE multiples and determine whether markets are cheap or not. I mean, where are the stock ideas, which are great businesses available at reasonable valuations? PEGs are still by and large above 2.5 times or so, maybe even 3 times. Excuse me.
Fair point. So then what would you look at to decide it's a good time to buy or not? Because we've spent enough time in the market. What looks like exaggerated right now, year from now would look passe. I mean, it's just that when you go through that phase of derating and decline, it feels like end of the world. In post-COVID also, we've seen 3 phases like this. I mean, a year from now, maybe 6 months from now, this would turn out to be like a good time to grab stocks. So what are the criteria which you are using to say that, okay, I'm a buyer now or I'm not a buyer yet?
I think, Nikunj, you have to keep an eye on corporate earnings. And once you feel that there's a revival in earnings broadly and valuations are reasonable, by that I mean PEGs of around about 2 or below, maybe that's a good entry point. And also you need to look at a lot of other factors like what is happening on interest rate front. I'd like to see the FI buying come into positive zone because that will clearly mean that valuations are now attractive on a global basis. So it's not just one data point. I think it's many things. And also I think on the, we need more action on the government front, whether it's spending or whether it is path-breaking legislation, reduction of compliances, all these things are just frozen for the time being. So we are just taking the economic growth and earnings for granted. It doesn't work like that. And also, there's an element of cyclicality in businesses, and we are seeing a bit of a down cycle, which will naturally also correct itself in a few quarters or so. So, I mean, there's no simple answer that, look, this is the reason, and at this point, if this happens, it's a good buy. And not all stocks will turn out to be, good buys or entry points. It will happen even selectively, I would say. But most importantly, I think, we need to see a revival in the earnings. We need to see more confidence that okay, now the worst is over as far as earnings degrowth, or not degrowth but slowdown is over, and now we are seeing a broad revival in the corporate profits.
Right, okay, Dipan, stay with us. Lots to talk about. But let's address all the stocks and news as well this morning. And Snehi is here with that list. Snehi?
Well, yes, good morning. Here's a list of all the stocks to watch out for in today's trading session. First up, let's talk about some quarter 3 earnings that trickled in post-market hours yesterday. A good set of numbers coming in from PNB Housing Finance, because the net profit is coming at 483 crores, which is up roughly 43% on a year-on-year basis, so looking good for that company right now. However, inline set of numbers coming in from Jana Small Finance Bank, their PAT has fallen roughly 18% on a year-on-year basis. However, asset quality has seen improvement sequentially, so it's a mixed set of numbers coming in from Jana this time around. However, when you talk about the next list of companies, it's a weak set of numbers coming in from ICICI Prudential. Their VNB margins have seen a decline on a year-on-year basis. India Mart Intermesh also a weak set of numbers coming in. The revenue has come in at 354 crores, which is up 16% year-on-year, but still under what the street was estimating. Sion DLM2, weak set of numbers coming in. EBITDA margin has seen a contraction at 6.3% compared to 9.2% on a year-on-year basis. And Tata Tech also a very weak set of numbers coming in. EBIT margin has seen a contraction at 15.5% compared to roughly 16% on a sequential basis. But while this is the earnings fine print, let's move away from earnings and talk about some other stocks that will be in focus on the back of their individual news flows. Jio Financial will be in focus because the company and BlackRock have further subscribed to 5.85 crore shares of the JV Jio BlackRock Asset Management by investing 117 crore rupees. So Jio Financial will be in focus on the back of this news flow. Next up, watch out for Aditya Birla Fashion and Retail, which is ABFRL. They've successfully completed a 1,860 crore rupee fundraise via a QIP. The board has also approved the issuance and allotment of 6.8 crore equity shares at an issue price of 271.3 rupees per share. And major participants in this QIP include Amansa Holdings, Quant MF and Bofa Securities, among others. Lastly, also watch out for RailTel. Positive news flow coming in for this company. They've received a work order from Northwestern Railway for roughly 47 crores, 46.8 crore amount to be exact. So positive news flow for RailTel. Keep a close eye on that stock along with all of these other stocks in today's trading session.
Okay. Go back to Zomato. Dipan, it's logical to see that, or it's logical to perhaps understand why Zomato is expanding its presence in the quick commerce business. Now, if there is merit in Zomato's expansion because the terrain or the entire quick commerce terrain is getting more competitive, what ticked the market? I mean, why were markets so nervous just because they've said that we will not make cash, we will not make profit for the next 2 quarters because we are in expansion mode?
See, I think this is the impact of competitive intensity increasing within the space that is reflected in the corporate numbers. It's reflected in the strategy of the management. And a lot of investors thought that break-even point for the quick commerce business would be, around the corner, but it's getting pushed up further. And management clearly is looking at gaining market share or keeping its market share rather than profitability, which is fine if you're a long-term investor. For example, as a measure of disclosure, we and our clients are invested in Zomato, but we are not selling on these numbers because we have a horizon of 3 years, 5 years, 10 years or so. And from that perspective, I think it is a winning strategy. And this kind of competitive intensity will last for maybe 2-3 years or so. And if Zomato is the winner after that, then there are huge upsides and huge profits to be made, as we saw in the food delivery business. That was highly competitive, then it came down to 2 players, and now that division is solid in profit. So I think that it's just a kind of a phase and a reflection of increased competitive intensity. It's going to be an interesting case study for investors and businesses, especially startups. So I'm not too concerned about the numbers, but the reaction also, because to an extent the stock is overowned, it's too hyped up, and a lot of positions also are there, maybe leverage positions also are there. So these are things which are impacting the stock price at this point of time.
Yeah, absolutely. Though in retrospect, when it jumped from 40 to 214, people were celebrating, and then it went to 300 and there was such a FOMO feeling, and now at 214, I don't think anyone has the courage to buy Zomato once again just yet. But from the corridors of the World Economic Forum 2025, we bring you exclusive conversation with Times Network's Mihir Bhatt. He's in conversation with Rajan Bharti Mittal from Bharti Enterprises, exploring his thoughts on the presence of Indians in Davos, the Make in India initiative and more.
Patricia, didn't we decide not
For past couple of years, India remains the dominant force at Davos, and we have seen a lot of vibrancy across Indian pavilions. What is your key takeaway so far, though it's only second day?
I would say the first working day. Yesterday was only meet and greet. It was a working day. And I think India's story remains vibrant. And that's why the participation also remains vibrant from Indian point of view. And clearly we are seeing it, the traction for India's story is there. Is the largest, fastest growing economy. India has to be on the, every CEO's desk if they have to go global. So I think from that point of view, and keep in mind that manufacturing, which has been a laggard till now, with the new initiative and especially Prime Minister's particularly saying that Make in India has to be done, I think that has given a lot of impetus. So that growth story remains, and we are seeing the changes. We never thought in our lifetime that manufacturing will get that much traction, which is getting. So I think it will be a good skew between manufacturing and services industry. Services industries have always got much higher proportion of investments, but now manufacturing is getting it. So India's story in that sense, fastest growing economy, policy direction, political stability, I think that's where it is.
If we look at global prospects right now, obviously we have Trump, he has just taken.
Okay, more voices coming up from the World Economic Forum. But it's surely been a volatile past few months for markets, with the Nifty down over 12% in the current fall itself. How bad can it get from here? And historically, how has the Nifty and, the averages panned out really with drawdowns that one has seen during intact bull markets? To analyze all of that, I'm going to hand it over to Kunal and Nikunj for that.
So Kunal, everybody is feeling the pain, right? Which is that, okay, portfolios have got contracted, some stocks have got smoked. But what to your mind is the average median decline in large cap, mid cap and small cap?
So Nikunj, we've analyzed the last 8 to 9 instances, and all of those instances where the Nifty is corrected more than 10%. So we've looked at how the large caps, small caps and mid caps have behaved. For example, in 2008, of course, 2008 and 20, they become exceptional scenarios, but we're still discussing that. 2008, the Nifty fell by almost 65%, top to bottom, in terms of price levels. Mid cap fell by 75%, small cap 77%. 2010-15 were those inter-bull market corrections where the index fell by 29%. Mid caps and small caps, they've also corrected in the same intensity. So we've gone through a historical data point over the last 9 subsets that how the index has corrected whenever we've corrected more than 10%. Currently, we are down 13% on the index. The mid caps have corrected by 14% and the small caps have corrected by 15%. So on an average, what we've seen is that X of those big bear markets like 2008 and 2020, we've seen the mid caps, to correct by 24%, large caps 19% and small caps by 27%.
Okay. How much have you corrected right now?
So we are almost at 17% on the small caps. So, and the historical mean is 27%, and we are 13% on the large caps. That's on the Nifty 50. Historical means have been 19%.
So let's go back to that graph again, which is that X of the bear market, which is what you need to look at, because this is not a bear market. As of now, doesn't look like a bear market, which means that we still have a good 7 to 8% more on the small cap to go.
On the large cap.
On the large cap to go.
Nifty.
Small cap we've already corrected.
17%.
10% more on the small cap.
More 10% on the small
And
cap.
mid cap?
Mid cap is almost around 8%.
So logically speaking, if we have to go back to the bear market, ex-bear market averages, the big
Correct.
falls which have happened,
Correct.
that means in order to mean, we may go to the average, we may not go to the average, we may exceed the average, we may not exceed the average. The downside is still open.
The downside is still open, but these entry points, if in case, so assuming if in case over the next, say 1 or 2 months, we fall by another 5-6% on the index, that becomes a very good value buying territory for indices.
Fair point. And that's the point which we're discussing, Aisha, that not today, not tomorrow, 5%, maybe 7%, maybe 10%, you reach what could be called as a value zone for the market.
Okay, awaiting that value zone, maybe some more pain in store to get to that level. But Dipan, that's the point, right? I mean, it's not like historically we've not seen extremely steep bull market corrections. But is it different this time, given that from those 2020 lows, it's pretty much been a one-way move up?
See, first of all, no, this is the walk in the park type of a correction. It was coming for a long time. It has been nice and smooth and slow. It has given a lot of opportunity for you to sell. And it was very clear that the market was going to correct. I think in the last 30 years, I haven't seen such a benign correction. Normally, it is just so quick. It doesn't give any opportunity at all. It's just like 10% in 3 or 4 or 5 trading sessions. It's not like that. Markets also, rallied in between this bear market or corrective phase as well. So I think it's perfectly fine. And, I really find the analysis quite interesting, which clearly shows that the market has some more way to go below. And rather than focusing on where is the value buy, I think we should focus on how can investors raise their cash levels and what strategies they can follow over there. And one simple strategy comes to mind is that overvalued stocks, when they start to disappoint on their earnings, that's a good point to kind of liquidate those holdings.
Give us an example. Where do you think overvalued stocks have started to disappoint?
Yeah, I think so. I think in many stocks we may be seeing that to an extent. Although I thought Dixon and Zomato were decent set of earnings, but a lot of these software companies, the likes of TCS, Infosys, Wipro, HCL Tech, the entire pack, I think investors are so bullish over their revival of the software services industry. But look, end of the day, their entire bar has come down. I was watching Tata Technologies interview, and the CEO feels that 1.7% constant currency growth rate is not a weak quarter. I mean, I don't understand. According to me, it's a very, very weak quarter for a company like Tata Technologies trading at such rich valuations. So I think that's what one needs to consider. I think even say company like Supreme Industries, a company which we and our clients are invested in, very, very disappointing set of numbers and very richly valued as well. So you will have these instances. I mean, you could add Dixon also to it. It's just that Dixon, Zomato, our cost price is so low, so we can weather this storm. But somebody who's bought it, at around about these levels or so, for them, I think next few quarters they may see further underperformance over there. So it's a time to be extremely careful which stocks you're invested in. And one really needs to have a proper strategy to raise cash levels. I think don't take the market for granted that, okay, it'll correct by 4 or 5% and instantly it'll come back up. This kind of a market is different from what we have seen amongst the many other corrective phases we have seen post-COVID. Earlier those corrections, be it the June 4th correction of the election or the budget day, you had the market quickly come back in less than 15, 20 trading sessions to new highs or previous highs or so. I don't think that's going to happen over here. And more importantly, I think the entire technical structure of the market has got very badly damaged. I think I'm seeing a golden cross. I think that's a question I want to ask a technical analyst. Sorry, a death cross. And according to me, that's a very, very important technical indicator which suggests that the markets can trade significantly lower from these levels.
Is that a death cross?
Yeah, that's a death crossover. So death crossover generally is a definition which means that it's an end or a death of a bullish momentum and shift towards the bearish sentiment for the index. But historically, moving averages have had a lagging effect. So only in periods of big bear markets like in 2008 or the dot-com bubble 2000, only these were the points where the post the death crossover, the indices have fell by another 10% to 15% further. So in the normal phase of corrections, death crossover generally means that it's just a shift from the bullish sentiment towards bearish sentiment, and maybe another residual correction of 3, 4, 5% could be in the offing.
But it could be different this time, right? I mean, for a roaring bull market, even us dragging in a range and being flattish, barring those minuscule jump ups, news-based and what have you, is also technically bearish, right? Because you're so used to staggering returns up until 2024 October.
Yeah, it was because, so I think as Dipan was also saying that, earlier there was correction of 5%, 3% for the indices, but in the next 10-15 days, we made a new high for the index immediately.
Exactly.
So you're
it was
prone,
so quickly lapped up.
Yeah, we are bound to that V-shaped recoveries every now and then, but that's not happening this time around. I think that should be more painful for the market participants.
Yeah, absolutely. But what is it looking like? Does it look like it's going to be a full structure change from bull to bear, or is it just going to be ranged and very sedate returns that we're headed in for the latter part of the year?
So I think second half of, or rather first half of this year, it should be more challenging. My sense is that, so as we were discussing, that there should be another residual correction of 3% to 5% at least for the indices. That may take a span of 1 month, 3 months, or maybe 5 months, but that should probably impact the first half of this calendar year.
Okay. Not looking good. Whether you look at valuations, whether you look at the global setup, whether you look at the mood and the momentum. And Dipan, I was just thinking through it that the hurrah for us is DIs. Now, if markets correct another 5-7%, the two-year or 2.5-3-year SIP flows would then start giving you negative returns or no returns, and that becomes the tricky part, because flows are coming into Indian markets because returns are there. If the returns are not there, and if suddenly equity market 2-3 SIP returns are 2-3-year SIP returns are flat, then what happens to domestic liquidity? Frankly, that for me is the biggest puzzle rather than anything else.
You're right. I think we didn't discuss domestic investors' behavior. And this is the first real challenge for the investors who entered post-COVID. I think if this corrective phase lasts for a month or so, I don't think from 2020 onwards, we have seen multi-month negative returns. I mean, I can go back and check that point. That's one aspect. Also, yesterday, we had the DIIs buying significantly lower value than the FI. Is that a trend? Second point. And thirdly, I think we also need to look at the IPO market and the QIPs and the promoters selling, how that also, that particular supply side is behaving. So it's very difficult to make a call. See, estimating the liquidity in the market is extremely difficult. But right now it does seem that liquidity is ebbing, and also more importantly, Nikunj, broadly Indian mutual funds, domestic institutional investors are price takers. Means they'll keep on buying, but it's not that they aggressively go and chase the stock on the way up. They keep on keeping lower and lower limits to buy, and that's how the stock price may continue to come down, but they absorb the supply which is coming in. It's the FIs who are the price makers, and they're the ones who are selling left, right, and center, as is evident on the screen.
A minute 40 to go, and we don't have too many newsmakers. So, Dipan, how much cash have you raised? How much of your portfolio is now already been booked out or locked out?
Not enough, Nikunj. Not enough. I wish. I mean, for someone who had been predicting this kind of a bearish correction, I don't think we have enough. But I think across portfolios, anywhere from 15-20% would be in cash. Also, surpluses are not being deployed in the equity market as they normally would have. And of course, there's no leverage position at all within our portfolios or that of our clients, no F&O position. These are the same things that tell every investor I meet that, have a very strong look at your balance sheet. If you have EMIs, if you have personal loans, if you have margin trade funding, if you have any kind of F&O position, this is the time to square off, book your losses. I know it's a bit of a setback, but you have to brace yourself. I think winter is already in, and it could be a long one.
Winter is already in, it could be a long one. Nuresh? Winter is already in, it could be a long one.
So, say, if we look at the prices, apart from the index, we are already down 20-25% on most stocks. So the median fall is 20-25%. And what we see currently is a very similar scenario to a correction which happened in 2021 to 23, 2015 to 2016, wherein the indices corrected 15-20%. And a lot of stocks go through a major shift. So the case is, if you go to 2021, all digital, all pharma, all COVID beneficiaries did not come back, and most names are even still down below those levels. So the most important point is what not to do rather than looking at the correction. So there should be a shift. So my view is we are getting into a similar correction, but we should get more clarity post-budget, because this correction is purely India in the making. We've not seen any of the other global indices hit multi-month lows. So post-budget also, if there is no, say, change in sentiment, then we get into a correction like 2021-23. Or if there is a decent budget, we get back into the, say, a global correlation. For now, that has been broken.
All right, Naresh, that's the take coming in on the index. But with this, Dipan would like to thank you for taking the time out and speaking with us, and also helping with your take on the market.